Welcome back, dear learners. Before the ad break, we defined or we spoke of interest being capitalized. In today's class, I have a question that I want us to do together. It is an extract, pre-adjustment trial balance of Bruley suppliers on the 31st of December. And then we have our balance sheet account section as well as our nominal accounts section. And then we have adjustments, which is adjustment number 1. And then we have adjustment 2, 3, 4, and then adjustment number 5. So we want to do these adjustments and see how to record them in our statement of comprehensive income. And if they affect the statement of financial position, we will also create notes that relate to the statement of financial position. But our main focus is the statement of comprehensive income. So let us now begin with our first adjustment. Our first adjustment has to do with salaries. It reads, the following details of an employee DPD were omitted from the salaries journal for February. So remember, our financial period is 12 months. This is beginning in March and it is ending in Feb. So we are being told we have an employee DPD. His details were omitted from the salaries journal for February. So we are looking at 1 month where his details were omitted. And we are told the gross salary is given 20,000. And then we have deductions given here. Then it says, note, the company contributes 4% of employees' gross salary to the pension fund. So here we're dealing now with contributions, where we have contributions that go to the pension fund and then also to the UIF. And we're being told that it is on a rand for rand basis. And then very important information is that the employer's contribution is included in the salaries account. So when we are now recording our contributions, we must record them together to the salaries account. All right. So the first thing is, what do we do when we are preparing our statement of comprehensive income? You have to understand that your salaries are expenses to the business. So the first thing is that your salaries must be recorded under our operating expenses. So when we record this adjustment, we have to think in our minds, operating expenses. So I'm going to come under my operating expenses and I have my salaries here. I'll begin with the amount that is given in the nominal accounts of 96,000. That is what I begin with here. All right. So I take the amount from the nominal account section. Now I'm being told a new employee has details that were omitted from the salaries journal for February. So that means I need to add the details of this new employee. When I am recording in my statement of comprehensive income, I will record the gross salary. So I need to know how much is our cost for this particular employee. And our cost for this particular employee, we see it in the gross salary. So I will take the gross salary as it is. I'll come here and I'll say 20,000. That is the gross salary. So I've added my 20,000 to the amount that is in the nominal account section. So I have my 96, then I come and I add my 20,000. However, we would then think, what about the deductions? You have to understand that deductions are in the gross salary. So the moment you recorded the gross salary, you have already recorded the deductions, because deductions are inside the gross salary. All right? So there is no need for you to record the deductions in the statement of comprehensive income. The moment you record the gross salary, you have already recorded the deductions, for the deductions are inside the gross salary. But we will need to record what are known as contributions. And it says the company contributes 4% of the employee's gross salary to the pension fund. So I need to do calculations for the pension fund. And for me to do that, I will now say, how much is the employee's gross salary? it is 20,000, and I'll say my 20,000 multiply by 4%. All right, this will give me 800. This is what you see here, plus 800. That is what I add now to my salaries. I add that 800. And then the next one is the UIF. And my UIF is 1% of gross salary. So I'll take my gross salary again, which is 20,000. Then I say multiply by 1%. And this will give me 200. So I'll come here and get my 200. When I am done with this now, then I can get my amount that goes into the final column of my salaries when I'm preparing my statement of comprehensive income. So let me say this again. When you prepare your statement of comprehensive income, what we will record, it is the gross, the 20,000, the same one that we see here. And then I'll come now and record my contributions. And here I have first the pension fund as well as the UIF. That is what I have recorded there. Then the next question is, what then is recorded when we go to the statement of financial position? We go to the trade and other payables note, that is where we record all the amounts that are owing, the trade and other payables note. So the first one that we begin with is creditors for salaries. This creditors for salaries, this is what you would have understood to be your net salary. So your net salary, we record it as creditors for salary. That is your net salary. How do you get that? You say your gross minus all your deductions. That is how you get your net salary. Then you will bring your pay as you earn, the 3,000. All right? Pay as you earn, it's 15% of gross. That means you take your 20,000, then you multiply 15% of that. That is how you get the 3,000. And then you record your UIF. In your UIF, the first 200, it is the deduction. And if you come here, it says UIF 1%. So we've calculated 1% already, that is 200. And then the next 200, it is your contribution, whereby you are told UIF is contributed at 1%, on a rand for rand basis rather. So the same 200 that is being deducted, we multiply that by 1, then we get our contribution. That is how you get the 400. When we come to pension fund, we first bring the deduction, which is 2,650, the one you see here. And we are then told that the employer contributes 4%, all right? And then remember that same 800, that is what we then have here. And then we have the 3,450. This is how we would record our salaries adjustment in both the statement of comprehensive income under operating expenses and in the statement of financial position under your trade and other payables. All right, let's look at the next adjustment. Our next adjustment reads, water and electricity account for December has been received but not yet paid. The outstanding amount is 450. Once we have not yet paid for it, it becomes our accrued expense. So this is an accrued expense. And when we come to the statement of comprehensive income, we take the amount in the nominal accounts, water and electricity, 4,950, the 80 is. And then we have to consider that there is an amount outstanding of 450. So we come and we add it. And then we end up with 5,400. So when we prepare the statement of comprehensive income, our accrued expenses, we add them. We add our accrued expenses. But when we prepare the statement of financial position, they come to trade and other payables. And then you have your accrued expenses, that is 450. Let me repeat that again. When we have an accrued expense, how do we know it is an accrued expense? When the amount has not yet been paid and we're told the outstanding amount is 450. So I'll come here and say, water and electricity, I take the amount from the list of balances. Then I add the accrued amount so that I can have my 5,400. That is the expense for the financial year. And the amount that is accrued goes to trade and other payables. Dear learners, let's go for an ad break, and I'm going to see you shortly.